Every government promise eventually breaks. In 1971, the U.S. closed the gold window with a single televised address, erasing a decades-old international commitment. That moment exposed a brutal truth: legal contracts, signatures, and state guarantees are only as durable as the political will behind them. What if money didn't need anyone's word? What if the rules were enforced not by courts and guns but by mathematics that any computer can verify? Bitcoin is that experiment. It embeds scarcity, ownership, and transaction finality into cryptographic functions so rigid that breaking them would require more energy than the universe can provide. Over the next few minutes, we will reverse engineer that machinery, from SHA-256's one-way data grinding to the elliptic curve trapdoor that guards private keys, and finally to the probability theory that makes rewriting history economically insane. This is not a story about ideology, it is a tour of Bitcoin's mathematical constitution. Human trust has always required a violent backbone. A banknote is a liability of a central bank. That central bank exists because a sovereign power backs it with force. When a regime collapses or decides to renege, the paper becomes worthless overnight. The post-war global monetary order was built on solemn international agreements, and yet it was unwound with a few directives. The same fragility infects all institutional guarantees. Cryptography offers a way out. Instead of believing a promise, you verify a proof. A message signed with a private key can be authenticated by anyone using the corresponding public key, with no need for a judge, notary, or payment processor. The validator doesn't need to know who you are, the math alone confirms that the signature was created by the holder of the secret key. This flips the entire trust model. The source of certainty is not a person but a one-way function that cannot be forged with any known computing technology. Compare the two systems side by side. The institutional model depends on continuity of a political entity. If the government falls or changes policy, the asset's value can vaporize. Even in stable jurisdictions, monetary expansion slowly erodes purchasing power, a deliberate design of modern central banking. The cryptographic model, built on SEC 256K1, does not rely on any human organization. Given the public key, any participant can confirm a signature without ever learning the private key. The strongest known attack against this scheme, Pollard's row, requires about 2 to the power of 128 operations, a number so large that even if every grain of sand on Earth were a quantum processor, the computation would not finish before the sun burns out. This asymmetry, easy to create a signature, impossible to forge one, is what puts mathematical trust in a category of its own. It does not need to be defended with armies, it is defended by the physical limits of computation itself. Bitcoin's first security layer is the SHA-256 hash function, a mathematical mixing engine designed to be absolutely one-way. Feed it a gigabyte file or a single punctuation mark, out comes exactly 256 bits that look like random noise. Its core uses the Merkle-Damgard construction. The input is chopped into 5 12-bit blocks, each of which is processed through a 64-round compression function that interleaves nonlinear bit logic with rotation and addition. These operations, majority, choice, and sigma functions, create intense diffusion and confusion. Change even one bit in the input, and roughly half the output bits flip, a property known as the avalanche effect. This makes finding an input that hashes to a target digest a brute force search through an impossibly large space, 2 to the power of 256 possibilities, comparable to the number of atoms in the observable universe. Bitcoin further hardens the chain by applying SHA-256 twice, once to the transaction data and again in the mining puzzle. Even if future machines weaken a single hash round, the double layer adds a deep buffer. Why did Bitcoin's designer choose SHA-256 over its predecessors? The numbers explain everything. MD5, once a standard, has a collision probability around 10 superscript 1, which sounds small, but in 2004 researchers actually constructed colliding inputs, killing its security. SHA-1 fares better at about 10 superscript 2, yet in 2017 a joint Google CWI team demonstrated the first practical collision, confirming structural weaknesses. SHA-256 pushes the collision probability to roughly 10, a number with 76 zeros after the decimal. Even if you had been running trillions of attempts per second since the Big Bang, you would not have come close to a collision. This is not a guarantee of eternal safety, but it sets the difficulty at a level that current and foreseeable technology cannot overcome. Bitcoin's additional double hash practice provides defense in depth. Should a single SHA-256 someday show marginal weakness, the second application still forces an attacker to overcome two independent hash problems. Inside each of the 64 rounds, 8 state registers are scrambled using a mix of linear and nonlinear operations. The round function blends the current message word, a unique round constant, and the previous state through 2 summary legs. The first leg computes a value that absorbs the message and the B register via the sigma and choice functions. The choice function conditionally selects bits from either F or G based on E, breaking linearity. The second leg combines the majority of the top 3 registers with another sigma function. These 2 intermediate values update the state in a cascading manner, with each register shifting position to create deep entanglement. After 64 iterations, every output bit depends on every input bit in a statistically perfect mix. This design means that predicting or reversing the hash is equivalent to solving a system of highly nonlinear equations over billions of possible states, a problem for which no efficient method exists. Bitcoin's ownership model rests on a deceptively simple algebraic structure, the SEC256K1 elliptic curve. Its equation, y superscript 2 equals x superscript 3 plus 7 defined over a prime field of size approximately 2 superscript 2, creates a set of points that, under a special addition rule, form a finite group. A generator point G is fixed and known to everyone. A private key is just a huge random integer. The corresponding public key is that integer times G, using repeated point addition. This scalar multiplication is fast. It scales logarithmically with the key length, taking a few hundred point operations. Going the other way, finding the private key given the public key, is the elliptic curve discrete logarithm problem. No sub-exponential algorithm is known. Pollard's row method runs in about 2 superscript 1 superscript 2 steps, a number that exceeds the computational capacity of any realistic machine, classical or quantum, for the foreseeable future. This asymmetry between signing and cracking is the bedrock of Bitcoin's non-custodial ownership. The private key never needs to leave its owner's control, yet the public key can be broadcast to the entire world with no risk of reversal. The point addition formulas might look like high school algebra, but they define a mathematical group of enormous cardinality. To add 2 distinct curve points, you draw a line through them. It intersects the curve at a third point. Reflect that third point across the x-axis and you get the sum. The formulas compute the slope of that line, then find the intersection's coordinates. Everything is done modulo a large prime, so the points jump around the plane in a chaotic, unpredictable pattern. Doubling a point uses the tangent slope, again derived from the curve equation. These 2 operations, add and double, are chained together to perform the scalar multiplication kg without ever revealing k. The security relies on the fact that while you can compute the slope and next point forward easily, reversing the process requires solving a discrete log, for which the only known strategies are brute force searches of a set larger than the number of atoms in the universe. The choice of elliptic curve cryptography over RSA was an engineering decision with clear quantitative justification. To reach an equivalent security level, RSA keys must be dramatically larger because the number field sieve attacks the integer factorization problem with sub-exponential complexity. In contrast, the elliptic curve discrete log problem appears to have purely exponential complexity, so key sizes scale linearly with the desired security strength. For a 128-bit security target, RSA demands a 3072-bit key, while ECDSA achieves the same with just 256 bits. As security requirements rise, the gap widens. At 256-bit security, RSA balloons to over 15,000 bits, whereas ECDSA only needs 512 bits. This compactness is critical for a decentralized network where every node must validate thousands of signatures. Bitcoin signatures average about 70 bytes, enabling efficient verification and propagation while conserving block space. The mathematical properties of SEC256K1 thus directly translate into practical network scalability. Bitcoin addresses are not directly linked to any identity, they are cryptographic commitments. The journey from a private key to an address is a one-way trip through 3 hash functions and an encoding scheme. First, the public key is computed from the private key via the SEC256K1 trapdoor. That public key is then hashed with SHA-256 and subsequently with RIPEMD160, a dedicated 160-bit hash function selected for its tight security and smaller output. This double hash design provides redundancy. Even if one of the hashes were weakened, the chained computation would still hinder reversal. The resulting 160-bit digest is suffixed with a checksum and converted to a human-friendly address using base 58. Recovering the private key from an address requires reversing both RIPEMD160 and SHA-256, and then solving the elliptic curve discrete log, a combinatorial defense that pushes total attack cost beyond any realistic horizon. Even with Grover-accelerated quantum search, the effort to break RIPEMD160 alone would still be 2, which remains technologically infeasible today. When you broadcast a Bitcoin transaction, you don't send a username and password, you provide a mathematical proof. The signing process takes the transaction hash, your private key, and a random nonce, and produces two huge integers, R and S. Any node receiving the transaction reconstructs the public key from the signature and checks whether the computed curve point matches the claimed R. If the equation holds, the node mathematically confirms that the message was authorized by the holder of the corresponding private key, without ever learning that key. This neutral, code-enforced adjudication replaces the entire apparatus of banks, notaries, and legal contracts. The only critical operational rule is that the nonce K must be unique and truly unpredictable. Reusing a nonce or using a weak one allows an observer to solve for the private key, an attack that has unfortunately been exploited in real-world wallet implementations. When properly generated, however, the signature is unconditionally unforgeable under the current state of cryptanalysis. What miners do is not complex math, it is brute force applied to a lottery. They take the block header and repeatedly hash it with a trial nonce, hoping the resulting digest falls below a difficulty threshold. The threshold is set so that the entire network, with all its combined computing power, finds a winning nonce approximately every 10 minutes. The success probability for a single hash is vanishingly small, target divided by 2 superscript 2, and so mining is a continuous Bernoulli trial. This probabilistic mechanism removes any need for a central clock or block producer. Anyone can join, and the work required is proportional to the computational effort expended. If an attacker tries to rewrite history, they must redo the proof of work for all subsequent blocks, a cost that grows exponentially with the number of confirmations. The Bitcoin white paper quantified the attacker's success probability with a binomial distribution. For 6 confirmations and an attacker controlling even 40% of the network, success probability drops to the single digits, and the required electricity cost typically outweighs the potential loot. This turns network security into an economic calculation. The rational miner finds honesty more profitable than attack. The financial gravity of Bitcoin's security comes from a single statistical function. As more blocks are built on top of a transaction, the probability that an attacker can secretly create a longer chain and overwrite history plummets. The formula accounts for the attacker's relative hash rate, the number of confirmations, and the stochastic nature of block discovery. Notice how Q appears in both the Poisson parameter and the exponential tail. When Q is significantly below 0.5, the term Q/P (Z K) decays rapidly. With typical 6 confirmations and a plausible 10% attacker share, the catch-up chance is effectively 0. This is not a legal guarantee or a service-level agreement, it is a mathematical consequence of the immense energy the honest majority has already sunk into the chain. The more work accumulates, the harder it becomes to undo it. That is why seasoned Bitcoin holders treat 6 confirmations as finality, not because someone promised, but because the cost of reversal would need to exceed the value of the entire transaction volume over several blocks, a threshold that rationally never gets crossed. Bitcoin's value proposition is often framed as digital gold, but the comparison runs deeper than metaphor. Gold scarcity derives from geology and extraction costs. However, new discoveries could expand the above-ground supply, and a significant fraction sits in vaults where physical verification is cumbersome. Bitcoin scarcity is absolute and known in advance. The Coinbase reward halves every 210,000 blocks, and total supply converges to 21 million. As of August 2026, annualized inflation is below 0.9%, already lower than gold's mining rate of about 1.5%. Meanwhile, fiat currencies have a supply that expands at the discretion of monetary authorities, a feature that systematically erodes purchasing power. The current policy rate environment and the expansion of central bank balance sheets since the global financial crisis illustrate that dilution is not a bug but a design. Bitcoin does not eliminate volatility. A drawdown from local highs is still possible and has occurred periodically. But the source of that volatility is market price discovery, not a hidden printing press. For a portfolio, this distinction matters. An asset whose supply cannot be manipulated provides a hedge against monetary debasement that gold can only approximate. A few key metrics ground the discussion in current reality. Bitcoin is trading near $63,150 as of early August 2026, having held relatively stable over the past 3 months despite significant turbulence in gold, which fell over 12% in the same period. The protocol's built-in deflationary nature means new coin issuance is now under 0.9% annually, a rate that will have again in 2028. The network's hash rate, a proxy for the total capital and energy committed to security, exceeds 700 exahashes per second, a figure that implies tens of billions of dollars in specialized hardware and electricity. The supply cap, 21 million coins, is not an aspiration, it is a convergence point enforced by over 15,000 nodes running the same consensus rules. These numbers illustrate that Bitcoin is not a theoretical toy. It represents a functioning, autonomous monetary system where the rules are written in code and enforced by mathematics, open for anyone to audit but impossible for any single actor to unilaterally change. We have traveled from the collapse of the gold window to the unyielding logic of SHA-256 and SEC-256K1. The conclusion is unsettling in its simplicity: mathematics is more durable than any institution. Bitcoin does not rely on armies, signatures, or political continuity, it relies on the one-wayness of hashing, the trapdoor of elliptic curves, and the probabilistic finality of proof of work. Each of these components is independently verifiable with nothing more than a terminal window. The network has not been flawless, human-side key management and exchange custody remain weak points, but its cryptographic core stands untouched by 14 years of relentless adversarial scrutiny. For an investor or builder, the question is not whether Bitcoin will win against the dollar, but whether an asset with absolute scarcity and censorship-resistant settlement deserves a place in a diversified portfolio. That is no longer a speculative gamble, it is a probabilistic strategic allocation. First control the risk, then consider the return. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.